Good afternoon, everyone. Thanks for joining us here today for the SIA Wealth Update webinar hosted by BMO Global Asset Management. I'm Kyle Wilson, Associate PM here at SIA Wealth. In just a minute, we'll hear from Jeremy Fehr, CEO of SIA Wealth Management. We'll provide a broad market update through several charts and some commentary on the unique things that he's seeing out there in the marketplace. Shortly after that, we'll hear from Paul Vendrinsky, Portfolio Manager at SIA Wealth, who will discuss the 5 BMO mandates, which we sub-advise, in a quick update on the portfolio's positioning going into the summer. There will be a little bit of time at the end available for Q&A, we believe, so feel free to relay those to us. We'll do our best to answer them. And with that, Jeremy, you're good to go and take it from here.
Thank you, Kyle, and thanks everyone for joining us today. In a continuation of our topic that we've been working on, the robot versus bear, using artificial intelligence powered by SIA to combat potential bear markets of the future, we want to do more regular updates with you on the market conditions and how our BMO products have been performing during those markets. So as Kyle mentioned, my name is Jeremy Fehr. I'm the founder and CEO of SIA Wealth. I've spent over 20 years in this industry, started as an investment advisor way back in the late 1990s, and have developed the software that is powering SIA charts and founded SIA Wealth over that time frame. We've now grown to over 520 advisors across Canada who are subscribing to our service at SIA Charts, but more importantly, we've now gone well over $1 billion in assets that we're managing through many of our mandates, including the BMO mutual funds and exchange-traded funds. So today we're going to talk a little bit about what's happening in 3 subjects. We're going to review the equity action call and the asset class rankings, our top level of analysis. We're going to look at that and see if there's been any change since our most recent update. We've certainly moved a little bit into May, and we've seen some downturn in the market, some confidence that's been eroded slightly based on some trade talks and some economic data. So let's see what impact that has had, if any, on our equity action call and our asset class rankings. We'll move then into market commentary. I'm going to go through a number of charts that I feel are very relevant for timing of the markets and understanding what's been going on over the last little while. So we'll go through that. And then finally, we're going to get a portfolio update from Paul Vendrinsky, our portfolio manager at SIA Wealth Management. He's going to go through a number of our strategies that we sub-advise with BMO Global Asset Management. Before we get on to our top-level analysis, I wanted to remind everyone, these are some slides from our Robot versus Bear seminar last month, but I really want to remind people why it's so important to have services that SIA produces through our products with BMO Global Asset Management. Bear markets have such a tremendous ability to erode value to clients. As most of you are well aware, our clients are largely the baby boomers who are now moving into the retirement phase, the oldest of which are now in their 70s. So bear markets, although we've had those in the past, and it has been common attitude to use just buy and hold strategies or diversification prior to bears, ride them out and see the backside of it. I think that the history that we show here on this slide, the Dow from 2000 to 2002, 2007 and 2009, and then the Canadian market, the S&P TSX from 2000 to 2002, and then subsequent 2008 to 2009, really highlight the devastation that can happen to portfolios, and more importantly, how long it takes to recover from that and what that will mean today versus what it did back then to our clients who are now either in retirement or extremely close to it. These 6 and 5 year timeframes to recovery are probably not going to go over too well with them. So it's more important, and all the people that work at SIA Wealth Management are dedicated to that cause to avoid those bear markets as much as possible using our technology. So again, what do declines look like? We can see declines of 10%, very close to return need to break even, 11%. But when we start seeing what we consider real bear market territory, when you're getting down into that 33% drawdowns to even 75%, which we saw in the NASDAQ in 2000 and some of the other markets, it takes tremendous effort, 50% to recover from a 33% drawdown. That's going to take your clients some time, even at a very good rate of return. It's going to take a very long time for them to get even. And if you look at some of these major drawdowns that we've had, 50% and even 75%, which we've all seen client portfolios come in or were involved with those prior to using defensive strategies such as SIA Wealth provides, 100, even 400% returns need to get back. These are the types of problems that our clients are not likely to forgive us for going forward. So we're going to need technology. We're going to need strategies that come through SIA Wealth Management and BMO Global Asset Management to defer those losses as much as humanly possible. So our first chart I want to look at today is our equity action call. This is our highest and first level of analysis. Looking at the equity action call to the far right, we can see we're still in the green zone. So we haven't seen any deterioration since the last time we spoke a month ago. We have seen some more volatility come into the market. None of this has been tremendously significant on our indicators. But again, we see a green zone here, which is telling us that we need to remain as invested as possible in the market. So at this moment in time, the EAC, the equity action call, is not providing us any concerns and has not changed even with the recent activity. The asset class rankings, which is our second level of analysis, we've got U.S. equity, international equity as the top two asset classes. This is where we're going to focus our attention on any purchases and assets that we have. Cash has hung in very strongly in third place above Canadian equity. We would love to, in a green equity action call, see Canadian equity do better. But as most of you are aware, we've seen a tremendous amount of lagging of Canadian equity versus U.S. and more recently international equity for some time. So seeing it in fourth spot, we'd like to see it move into third, followed up by bonds, currencies, and commodities. Commodities, obviously a big influencer on what happens in the Canadian marketplace, remains steadfast in its seventh position. So nothing has changed over the last 30 days since our last update. We're watching closely. We have seen stronger bond activities, and Paul will speak to our bond fund later in this presentation, where we've seen tremendous strength in fixed income over the last little while. So we're watching that closely to see if it's going to overtake Canadian equity, which continues to struggle relative to some of the other asset classes that are in here. But as it sits today, there have been no changes. So we'll continue on with our U.S. and international equity exposure in our mandates. With that, I'm going to move on to the market commentary. I'm going to start with a chart that you will see quite frequently when we do analysis on these market updates, which is the SIA charts market equal weight index. This index is comprised of an equal weight basket of U.S., Canadian, and international equity. So this is a great chart to look at when you want a broadly diversified analysis of what equities are doing around the world. It has moved up. This chart did move up. So after our last update in late April, we saw this chart move up a couple of boxes up now right against resistance. So just below that 69,633 level. So a breakout above that would be very, very bullish for this chart. We have seen a pullback. It hasn't moved back. You can see, if you can see that little red box, we've moved down to where the 3 is. So we're sitting approximately where March levels were. So we have had a little pullback, hasn't reversed into a column of O's. So a continuation here, a breakout above that 69,633 level would be very bullish from a chart analysis standpoint, and would correlate very well to what we're seeing in our asset class rankings and equity action call, which is that we remain in the green zone with U.S. and international equity on top. So we're continuing to watch this chart. Nothing negative has showed up in it as of yet, and certainly sitting there very close to what we would consider a very bullish pattern, a spread triple top breakout, should that happen over the next little while. So we'll watch this closely with significant upside potential on that breakout. The next chart I want to look at is the SIA U.S. Equity Equal Weight Index. This one has reversed into a column of O, so we've seen some weakness in U.S. equities. Where we would point that out has been happening in semiconductors. We've seen some blowback on some of the situations that are happening in the semis, both on a trade basis and Qualcomm specifically have had trouble over the last little while, so that's blown through the semis and brought them down. Drugs have not weakened that much, but continue to be one of the weaker of the top sectors that we're looking at. But when we go through all of the individual sectors that are doing well within the green zone of our sector analysis, we still see software, aerospace and defense, leisure, health services, and diversified services very, very strong. A new sector has moved in, utilities has now moved above consumer non-durables in the bottom part and is looking well. So there still is strength in most of the sectors that are up there. That's very bullish for us. We continue to see that as an optimistic outlook, but we'll continue to monitor this going forward. The pullback that we see in the chart presented, the SIA US Equity EWY, we see this as a normal course with it. We've had a strong run since early January when we reversed down in that 34,000 range, and we moved unabated right up to 44,000. So we saw a very strong return back up to resistance levels. A slight pullback here is to be expected. It's not uncommon when we see this, but we should expect to see some fall through. So that's something that we'll be watching closely going forward. As I mentioned in the previous slide, semiconductors have been hurt over the last month. That has also affected the NASDAQ, and that's why we largely see in the previous slide, column of O's has come largely from what's been happening on the NASDAQ and in its more technology and health-driven market. We see the NASDAQ, very, very similar chart to what we saw in the SIA US Equity EWY, where it's moved back into a column of O's. But again, still a very bullish pattern here. It continues to lead other benchmarks on a comparison chart basis, and we'll just watch closely to see if that 74.92 level is taken out over the next little while. So again, nothing to stress here to date. What this looks back is a normal course pullback after moving from strongly oversold territory to strongly overbought territory. The USD CAD, I wanted to put that chart in today. Recent activity with the Bank of Canada, again, is holding rates and does not appear that interest rate hikes are coming, at least in the near future. We continue to be in a column of O's, so there was recent strength after January of this year on the Canadian dollar, which moved it into a column of O's. But what we've seen recently is a move back to US. It hasn't reversed back into a column of X's, but we are sitting very close. That 135.10 level needs to be hit to get a column of X's with a 137.81 level to get that breakout. So if we do, and we're watching this closely, certainly central bankers will be watching this ratio in the United States and Canada, depending on their policy and where they feel the currency should be and interfering or injecting alongside of it. But we continue to be in a bullish pattern for US dollar over Canadian dollar, and just watching closely for first that reversal, and then secondly to see if we get that 137.81 level. If we do, that would be what we would consider a very strong bullish pattern for the US dollar, and subsequent strength is something that we would be looking for. A chart I want to bring up, and I'm going to move thematically over to commodities for the next number of slides. Certainly in Canada, this is still a strong area that needs to be working for us to see Canadian equity move up. And as you can see by this chart, the SIA Commodity Equal Weight Index has been in a bear market for a very long time. So this goes back to really the early part of 2011, late part of 2010. For those of you who have been with SIA Wealth Management or SIA charts since the latter part of 2010, you would recall that commodities have ranked very poorly in the asset class ranking since 2010, not really breaching into the fourth area for any time. Currently sitting in 7 out of 7 positions within our asset class ranking. So we're in bear market is in place. But we can see, and I apologize, the chart's a little bit small, but we're in a column of O's again, and we're going to retest our lows, it looks like, from back in February of this year, with a potential breakdown from there. So the bear market is still in place for commodities. This is not exactly what we would like to see if we were expecting to see a bull market reappear for crude or for precious metals or copper or other base metals. It would be good to see this chart showing some more strength. It is not at this time, so I want to spend the next few slides just going through commodities just to give you an understanding of what's happening and potential risks for your portfolios and your clients. So crude oil is our next chart here. We've finally seen a reversal in crude. It had its first negative reversal since December, so we've had a strong uptrend in this chart, moving 35 to 40% return from that $42 range right up to about $65, just under, just above. So it had a very, very strong retracement after a very negative year ending in 2018. So this was positive for crude. We've now seen a column of O's appear, so we would consider this overbought territory normally, and a reversal being something that would be very common. We can still treat it slightly like that. We're a little bit disheartened by the negative S-max of 3. So on a relative strength versus its peers basis, crude does look relatively weak. So those of you who have been investing in crude or potentially taking positions in it should be wary for the next little while. We'd like to see this reverse back to the upside. We feel that 67.10 level is an important resistance level to take out, and would likely give us an opportunity to break our recent downtrend line that we've seen happen since 2018. So we're watching that closely. 55.04 needs to hold on crude. A 53.96 tick would be another negative. We've already seen one negative support level taken out. Another one would be a little bit more of a warning sign for us. So we're watching this chart very closely. The next chart, I apologize here. The next chart I want to look at is copper. I apologize there. Had a little trouble with the application here. Copper, again, known as a global barometer of economic activity, has bottomed out, or did bottom out back in January. We were happy to see that. Continues to be in a downtrend. In May, we saw it reaching up and approaching its downtrend line. That was something that we were hoping would move to the upside. It has not. We've seen a reversal in the column of O's. So again, this shows us again that there's potential, and where that weakness is in that commodity EWI is really showing up recent crude activity and copper activity. So we're watching this chart very closely. So a 297 level would be a great reversal and breakout for this chart. It would be expected that that would probably take out the downtrend line for copper, giving us more confidence in what's happening in global activity. To the downside, we're watching that 254 level. So either one of those levels, we're in a relatively tight pattern in copper at this time. We want to wait and see which one of those levels gets taken out, and probably give us a strong indication of where copper is going in the future. One of the strongest commodities that we've been watching for some time is gold. Gold has held up better. Its chart remains in an uptrend pattern since the latter part of 2016. We've seen some strength in gold. It did have some weakness going into the latter part of 16 and early part of 17, but has recovered most of that over the next couple of years. We're sitting now at a level of 1,282. 1379 is a breakout level. That would be, to us, again, material. Gives potential upside to gold, and we're watching closely for that. This could be maybe a green area in what we've been seeing with commodities of late. To the downside, we have to be very, very wary of ticking below that 1225 level. There is support below that, but again, we would rather not see that 1225 taken out. 1177.75 level is a significant breakdown, so we'll be watching that closely as well. So overall, I wanted to go over the theme. We remain in a green equity action call, which is bullish for equities. So at this moment in time, we're going to remain at our full equity positions within the SIA Wealth portfolios. The asset class rankings have not changed since our most recent update. Again, U.S. equity and international equity should be favored amongst them. Canadian equity sitting at 4th spot below cash. The commodity charts that I brought up were specific to the Canadian equity, highlighting some of the problems that we've had with Canadian equity. There has been some leadership, and we continue to invest in some of the stronger areas of the Canadian marketplace, with our Canadian equity portfolios doing very well this year. But again, when it comes to the commodity side, we're continuing to see weakness, and more recently, some weakness that is leading us to believe that maybe new lows could be reached. So we're watching that very closely. With that, I'm going to turn it over to Paul Vendrinsky, our portfolio manager, and he's going to speak to our sub-advised mandates with BMO. So Paul, can you take it over from here?
Yeah, thanks a lot, Jeremy, and good afternoon, everyone. Thanks for joining us here today. I just wanted to give you a brief update on the 5 mandates we have over there at BMO, and also to give you a couple of ideas on how we've been working with some advisors to place the various funds and to tell the story with the 5 we have now. Firstly, we are very pleased to reach the 3-year mark here for the BMO Tactical Global Asset Allocation Fund. It hit 3 years right at the end of last month, and this is our balanced fund. And the fund has managed to maneuver through some volatile periods over the last few years. And one way to show that how this fund has changed during this period is the graph you're seeing on the bottom right-hand side here. What that displays is the allocation changes over time within the fund. So the yellow and the green, the light and the dark green, are really showing our fixed income proportions within the fund and how that changes and how that has changed over time. The ability, just to give you an example, back in the fall of 2018 on how we saw a shift where we were originally overweight equities, 60% equities, 40% bonds. We shifted in the fall of last year to a higher allocation, 60% bonds. And just to mention this first, because I think a lot of people are not aware of this, the bond positions, proportions, and holdings that we have within this fund are the exact same as we hold in the BMO Tactical Global Bond Fund. So these are the same holdings, just to let you know about that. But that shift to 60% of those same holdings allowed us at the time not only to cushion the equity weakness we were seeing, but also to perform very strong with the positions we had. Now, since then, earlier this year, we've moved back into a 60% weighting for equities. But since then, not only are we continuing with the strength we're seeing in broad equities markets, mostly U.S., we'll look at the holdings in a sec, but not only that, but also continued strength within the bond market. So basically, best of both worlds, both sides of the coin are doing great right now. So if you have a peek at our, like I said, third anniversary here, if you look at our 1-year number and our since inception numbers, you can see the strength we've had recently and over a longer term period, which has allowed us to rank fairly high within our peers within this global balance mandate. The 10.51 for 1 year and the since inception of 9.11 annualized over those 3 years have come both from strength within the equity and fixed income. A lot of times at different times, but as we're seeing right now, both of them are showing strength. One thing I wanted to mention here, like I mentioned, the bond component within this portfolio is the same components within our bond fund, but also our equity fund also. So just to give you an example, some people are using the asset allocation here fund as a one-ticket solution. So it's a balanced mandate, owns equities and fixed income, shifts based on our indicators, our equity action call, and moves automatically. Now, some people, maybe depending on their client, are looking for different proportions. You might have a 50-50 client or an 80-20 client. So one thing we've been doing working with clients is other advisors and wholesalers is how we can use, or they can use, our other funds to recreate this in different proportions. So just give you an example, our BMO Tactical Global Equity ETF fund, we hit the 4th anniversary on this one, by the way, mid-April. But this fund here is basically 35% of the weighting within our asset allocation fund. So this is something that can be used in combination with a couple of our other funds, depending on the asset allocations you're looking for. For example, right now you can look at the 6-month return of 7.42. If we jump ahead to the BMO Tactical Global Bond Fund, the 6-month is a little bit higher, but similar, 8.72. So they've been working in conjunction with each other for definitely the last 6 months, but really over the year, depending on where we've seen strength, which really paid off. just looking at this one again, for most people, for some people who might not know all the components within this fund, these are investment grade holdings only, but investment grade corporate and government bonds. Where this would slide into a portfolio or a bond portfolio that offers a little bit of a different story compared to the traditional Canadian income is that this is for investors not only looking for income from the yield, but also looking for global currency yield diversification. So for right now, most of this fund is on the U.S. side of the border, but on both sides, components are really right now U.S. and Canadian corporate bonds. And if you look at the one-year results here, we've had a very strong push in the corporate market, the corporate bond market. And even though 75% of this fund is weighted on the U.S. side, most of that 10%, 10 plus percent, it has come from the bonds itself. Currency is up actually less than 1% over that period. Looking at a longer time frame, we've hit the 4th year anniversary for this one also. We're sitting at 3.26 on an annualized basis. So for a global bond mandate, this has performed very well. And again, a big portion of the recent performance within the asset allocation fund. The other part of the asset allocation fund comes from a 25% proportion to 5 stocks. These are North American stocks. And even with this one, this new mandate that we've come out with, it's slightly different, but it is very similar in the approach it takes. This is our BMO SIA focused North American equity fund that was launched late last year, December 7th. It came out both in the mutual fund and also as an ETF, the ZFN. Now this is a concentrated portfolio of both Canada and U.S. stocks. So it's a portfolio of 15 equities. We're looking at the strength, the strongest names on both sides of the border and creating a portfolio. Most of the holdings right now are on the U.S. side. We have 3 holdings in Canada, but it kind of lines up to where we're seeing sector strength, which Jeremy was just talking about on the stocks. You can see consumer discretionary, technology, and utilities are the top 3 sectors within this portfolio. And this, similar to other mandates, has the ability to flow on both sides of the border, but also go to cash depending on our equity action call. So between this North American equity fund, the bond fund, and the equity fund, an advisor could change the assets and the allocations, more of like a choose your own adventure rather than a one-ticket solution, depending. So I'd encourage anybody to contact myself, even Ted or Jason, if you're looking for examples on how to customize that depending on the client. Last but not least is the BMO SIA Focused Canadian Equity Fund, also in ETF under ZFC. This came out the same time as the ZFN in early December, and this similarly is a concentrated portfolio, but this is looking at exclusively Canadian equities. And we've been off to a really good start since this has come out. Our trading model is outperforming the benchmark, and in the past 6 or so months here since the original launch, since inception, the fund is up around 12%. So not only is this very strong performer, but has done so with a very uncorrelated Canadian investment mandate. What I mean by that is the typical sectors, the banks, the mining, the energy is on a very low scale represented here. We have actually at this time no Canadian banks, no metals and mining, and one sole energy name. So this is a great way to get exposure to some of the other, I guess, Canadian companies that are not the traditional 3 main sectors. And because of holdings like Shopify, Badger Daylighting, CAE, we've seen some really strong gains here over these last 6 months. So I just wanted to give this quick update on these 5 funds. Really looking into the rest of this year, we're further to what Jeremy was saying. We're seeing strength in the current markets, but also all of these mandates allow us the ability to tactically shift when needed. With that, I would like to pass this on to Jeremy or really open up the floor too for any questions, and always encourage you guys to reach out to us with any questions going forward. Thank you very much for joining us today.
Thank you, Paul. Very exciting what's happening with the SIA BMO Global Asset Management products, our 2 new products, as well as the 3 that we've been running already for a number of years and celebrating some anniversaries. So with that, we'll open the floor and we'll turn it over to questions.
So if you do have any questions, feel free to type those in your web browser, and we will try and relay a couple of them here. First off, one question that we have, Paul, this is probably for you. In regards to the ZFC and ZFN, or the North American and the Canadian funds, do you track an active share measure on those portfolios?
Thanks, Kyle. Yeah, good question, actually. This is something we are tracking. We're able to do this with the stock strategies rather than the other 3, which are mostly ETFs, so it's hard to track active share. And for those who don't know, yeah, active share is kind of a way to identify closet indexers just to see how your holdings are doing compared to your benchmark. And really, because both of these ZFC and ZFN only hold 15 stocks, it actually has a very high active share, around that 90% mark. So a big part of that is because we only own 15, but you could see from the slide I showed just a bit ago, especially for the Canadian mandate, where we really have exposure to everything but the traditional Canadian. So yeah, to answer that question, it's about 0.9 and 0.92, I believe, between the ZFN and ZFC. And this is something we're updating, I believe, going forward in the monthly commentary. If you haven't seen that for last month, going forward you will.
I'll jump in here, and I think that's a very important point too with the Canadian side, given how concentrated the Canadian market is. I think that's really highlights how different we can manage monies, especially in Canada.
All right, good stuff. Have another one here. Paul, in regards to the bond fund, looks pretty good over the last 12 months. Can you elaborate a little bit more on some of the drivers of performance?
Sure. Yeah. Good question. The bond fund's interesting. We haven't had many changes in it for quite a while now. It was actually, you have to go back a couple of years when we shifted out of the longer term governments into the corporates, and really since then, and we are weighted heavier on the U.S. side, but both sides of the border has been the corporate bonds that have done well. And if you look at our duration, we're at around that 7-year mark. So right in the middle there, which has really done well over a rather schizophrenic central bank theme over the last, especially the 1 year. Started seeing indications that interest rates were going to go up throughout 2019, and then that completely reversed in the fall. And the positioning we had, not only the credit quality but the duration, helped us really benefit. And it was really the corporate bonds through that period that outperformed. And I believe I misspoke a little bit on that 1 year number. So we're up over 10%, but the U.S. dollar was closer to around 4. So you can see there was a lot of value that came from the picks above and beyond, whether we were in the States or Canada. So yeah, it's been a great 1 year, and even looking through inception, 3.25 positive.
All right. Awesome. Well, hang on. Looks like we might have one more in here. With regard to BMO Tactical Global, I'm thinking maybe asset allocation. Any interesting shifts, internal rebalancing to note with recent volatility over the past 4 months?
Well, within the fund, with that fund, we have the targeted weights for each of the allocations. So we target that 40% for fixed income and 60% for equities, and within both of those funds and the various holdings, those are not rebalanced daily, but they're held to those target weights. So and you know what, like I showed with that one, over the last 6 months, the equities as a whole, like our equity fund and the bond fund, have moved pretty much in lockstep. So there hasn't been very much need for any rebalancing. They've been moving together. That's a good question, and I would also say that, you know, on an ongoing basis, feel free to reach out to myself or any of our team for any other questions you might have. We are, like I said, we are sending out monthly commentary. It's on the landing page through the BMO website where you'll find that. And but of course, reach out if you have any questions.
Excellent. Well, it looks like that's it for questions here. So I think with that, we can shut it down. Thanks everyone for joining us. Feel free again, as Paul mentioned, reach out if you have any questions. We're always happy to help out, discuss the portfolios and you know, our positioning at that time. So thanks again for joining us, and enjoy the rest of your day.
Thanks everyone.